Hello, Finimizers, and welcome to another Finimize Live. My name is Theodora, your Finimize analyst, and I'm hosting today's event on Money Matters, a wealth roadmap with our partner AJ Bell. But first, we have some housekeeping to run through. Please feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. This will be a 15-minute workshop followed by a 15-minute audience Q&A. And you can use the Q&A box to ask a question. If you do see a question you like, upvote it so it moves right to the top. That way we can get through the most upvoted questions first. Okay, so let's kick this off. Our event partner for today is AJ Bell, who is on a mission to help women feel good investing. And they have a whole range of educational material, including a new female-focused podcast, regular articles, and events all designed with women in mind. Today, we're very fortunate to have Laura Suter with us. Laura is the head of personal finance at AJ Bell, and so she's got loads of experience in this field. First things first, how are you doing today, Laura?
Yeah, I'm good, thank you.
Great. I know you have an interesting workshop for us planned today, so let's get right to it, Finimizers.
Perfect. Thank you so much for that introduction. So I think first up, I just wanted to quickly introduce myself. 1 second. Here we are. So I am Laura Suter, as Theodora said. I'm a head of personal finance at AJ Bell. I joined the company just over 5 years ago. My main role at the company is to be a spokesperson for them. So I'm regularly quoted in the press, on TV or radio, talking about various financial topics, from what inflation's doing to interest rates to what's happening in the stock market, or increasingly at the moment, the cost of living crisis. While at AJ Bell, I also co-founded the Money Matters campaign. So this is our campaign to help engage more women with investing and with their finances more broadly. There's a huge gender investment gap in the UK, and we really want to help to close it by helping to educate and inform women and engage them more with their savings and ultimately to invest more. And prior to joining AJ Bell, I was a financial journalist for 10 years, working at various different publications, from national newspapers through to much more niche hedge fund publications. So hopefully that gives a bit of context about who I am. But today what we want to cover is, I'm going to run through different asset classes. I'm going to look at how to build a portfolio and why you need a strategy behind that. And then at the end, I'm just going to touch a bit on which account might be right for you. Now, I'm conscious that we'll have different expertise levels within the audience today. And so some of the initial stuff in terms of going through asset classes might feel a little bit basic, but they're the kind of building blocks that we then need to build our strategy off. So here is kind of all of the main asset classes that you might think of when you're investing. And all of them have a different payoff in terms of the potential reward or risk or return, and the time horizon that you might want to invest in them. And we're just going to go through them just to give us that basis before I start talking about some of the strategies that you might use. So let's start with cash. In the news a lot at the moment. It's seen as the best risk-free asset, although we know that inflation eats into cash returns. But you have the safety of putting £100 in a bank account. You come back a year later, you've still got your £100 there. And to add to that safety, deposits are covered by the Financial Services Compensation Scheme, up to £85,000 per person. So it's a very secure way of having your money, and you can have easy access to it. But often there are low rates. So at the moment, we actually are in a pretty good era for cash, and there are high interest rates out there. But we know that they're not as high as inflation. So we've seen interest rates rise, but inflation has always been higher than it during this recent kind of 2-year period. So that will really eat into the spending power of your money. So my example earlier of you putting £100 in a bank account, you come back a year later, there's still £100 in it, but that's going to buy you less at that point than it would have a year earlier, thanks to inflation. And then there's a big risk of what we call in the industry reckless conservatism. But boiled down, what that means is we're a nation that loves holding on to cash. We like the security of cash and seeing it in our bank account. But there is a risk that we're all holding too much cash and we're not benefiting from the higher returns that you could get from investing in other asset classes. And actually, to the kind of gender point and the work that we do at Money Matters, what all of our data shows us is the women are far more likely to hold on to cash and have that security of cash rather than investing it. Obviously, there's differences between women, but as a generalization, we're much more guilty of doing that. So then if we take the next step up the risk spectrum, we get to bonds. Here you have a coupon that's predetermined, so an amount of income that you get paid out that's predetermined, and then your original investment gets refunded when the bond matures. There's loads of different choice in terms of issuers, from governments to different countries to companies as well. And you can trade these bonds and you have good protection if a company did fail. The downside is obviously that the yields are often quite low, so that income that you can get is quite low if you don't want to take too much risk, and inflation will once again eat into those returns. So then if we go to the next level, we have shares, which is what most people think of when they think of investing. They're very good for returns over the long term. They've tended to beat those safer assets that I've talked about previously. They can also pay out an income in the form of dividends, but those aren't guaranteed in the same way that the income from bonds are. There's once again a wide range of companies, countries, sectors that you can invest in, so a lot of choice there, and you can get a lot of spread across different risk levels and different areas. And they can also offer inflation protection, and they're really easily tradable. As we all know, you can buy and sell them very easily in normal market conditions. On the downside, we all know that line that your investments can go up as well as down, or down as well as up. So we know that shares can be more volatile than other asset classes, and that in times of extreme market distress, it can be quite hard to trade them. We also have trading costs involved, whether that's the trading fees charged by your broker or the stamp duty that we have to pay when we buy and sell investments. And ultimately the risk that if a company fails, then you could get none of your money back. You're very low down the pecking order as a share owner if that company did fail. And then we move on to property, which lots of people like to invest in. And we're a nation that is also obsessed with property and getting on the property ladder, but also then buying second homes or investing in property. The good news is that it tends to rise in value over time. You get that steady income stream from rental income, and it can offer inflation protection. But both those values and those rents can fall. And as anyone who has tried to sell a property knows, it can be very expensive to buy and sell and take a long time to do so. So it's not a liquid asset. It's not an asset that you can trade easily. And the valuations are often dependent on the underlying sector. So whether that's residential, you're buying a second home or a buy-to-let property, or if you're investing more in shops and the retail area or offices. And then finally, we think of alternatives as a kind of coverall for a lot of other things. Now, this could be things from hedge fund and private equity like strategies to things like investing in fine wine or art or other kind of more esoteric areas, stamp collecting, for example. These are much more niche areas, and often they're more privy of either high net worth individuals, so very wealthy individuals, or just people that are doing it as a hobby on the side and wouldn't necessarily strictly class it as an investment, but they might hope that it might rise in value. Someone who invests in fine wine, for example, might do it because they're really interested in it and might hope that it might make them a bit of money, but it wouldn't be a core investment for them. They can be very volatile. They're quite expensive to store and insure if you are buying these physical assets, and they can take a long time to sell, particularly if you're operating in more niche markets. So they're a thing that we would say are kind of to the side of your portfolio and not something that would be in the core of it. And when we think about all of those investment classes, what we want to get in a portfolio is a very balanced mix, which always reminds me of these kind of plates that you were shown at school, that you need to have some vegetables and some fruit on there. You need to have a bit of protein or fish. And then you also need to have some of your carbs. And that's really how we should be thinking about our investment portfolios. We should be thinking about having this spread not only across asset classes, but also across the different regions, the different sectors within there. And I think why it's important to kind of go back to basics sometimes on these things is often when we start out investing, we start by buying a couple of things. We might buy a fund or two, or we might invest directly in shares. We might buy a few things and then we keep adding to it over the years. But we might realize that actually there's not an underlying strategy behind this. There's not an underlying kind of thought to getting diversification. There's kind of cherry picking different things along the way. And I know certainly when I started out investing, that was something that I was definitely guilty of, kind of picking up investments here and there, but not taking that step back and thinking, how does my portfolio look like as a whole? Am I overexposed to this area? Do I have any of this asset class in there? And so I think it's a really important exercise as investors to go back to basics on some of the asset classes and why we might want them in our portfolio, and to think about that balanced mix and whether we've got that. And there are lots of different routes that you can take with this. So I thought that I would run through some of them. And I think ultimately, all of these routes depend on the amount of time that you've got to dedicate to this, the amount of interest you have in it as well, because some people love investing, learning about it, researching it. Other people just want it as a thing on the side where they're making the most of their money, but they don't want to spend hours on it. And so I think different elements of these will appeal to different people and at different stages in their life. Right now, I work full time, I have a family, I don't have loads and loads of time to dedicate to investing. So I pick a lighter touch option. Maybe when I'm retired or coming close to retirement and I have a bit more spare time, it will become more of a hobby and I will invest more time in it. So we don't necessarily need to categorize ourselves in one of these for our lifetime. And so the first one that I would touch on is what we call kind of one-stop shop funds. These are, I think previously they were kind of called buy and forget funds, but I definitely wouldn't want to encourage people forgetting about their investment portfolio. But these are funds that are diversified. You buy one fund and you've got diversification in there. One of the most popular versions of this, or the best known names, I guess, is the Vanguard Life Strategy range. And within that range, you have different allocations to equity markets, all the way from 20% up to 100%. And that's kind of your risk part of the portfolio. And the rest is allocated to bonds or cash in some instances. And what you're buying there is a diversified portfolio that gives you the level of exposure that you want to equity markets. Now, that is one of the most best known ranges, but most investment platforms, lots of different providers now have a version of that. So whichever platform you're with will likely have a version of that. And you can target the level of equity exposure you want, depending on your own risk profile, and buy that. And it's a really great option for instant diversification. And also if you're starting out with a smaller amount of money and you don't feel like you can necessarily get that diversification and buy lots of different funds. Another option is a rules-based portfolio. So this is where you decide what you want your portfolio to look like, what allocation you want to different markets, whether that's UK markets or smaller companies, emerging markets, bonds, and you set those parameters. And then every 6 months or every year, you reset your portfolio back to those parameters, which would mean selling some of the investments that have done better and buying back into the ones that haven't, to ensure that you kind of rebalance that portfolio. Now you can flex those percentages over time as your circumstances change, but it's a good way to ensure that you've got a strategy underlying your portfolio. Another option is to kind of effectively outsource that. So you can buy model portfolios, or some robo-advisors out there will do this, and they will give you a ready-made portfolio of different funds, different asset classes, and you buy into that. And depending on the type of that, they will then rebalance it, or you might need to do some of that work yourself. And then the next strategy that I want to talk about is core and satellite, which some people might be familiar with. And this is where you buy a set of investments that form the central part of your portfolio, and then you buy other items around it. So you want that central part to be well diversified, broad. Often for some people, it might be a broad index tracker that tracks something like the MSCI World, which is a global index of companies all around the world. you might want something like that kind of at the center of your portfolio that's very diversified, and then you add bits around it, either depending on where you think there might be opportunities in the market or where you have a particular interest. So you might add a bit of emerging markets on top of that, or if you've got a really keen interest or knowledge of Asian tech companies, you might add that in on top of that. And so it's about making sure you've got that diversified core and a good spread at the core, and then you can around that do some other things that play to your interests or your particular areas that you think might outperform. And I think it's worth flagging favorite funds lists at this point. They will really give you a helping hand if you're doing that element of selecting funds yourself. Excuse me. And they will help to whittle it down, because, for example, if you go out and you say, okay, I want to buy a UK smaller companies fund, there will be hundreds, if not thousands, of those out there. And so these favorite funds lists can be really helpful in whittling down that list. And you don't necessarily need to stick to one. Most different platforms will have them. Other publications might have them. You don't necessarily just need to look at one. You can kind of collate between the two. But often they will let you streamline by, okay, this is the area of the world or the asset class I want to invest in. I want to access it actively or passively. And that will give you a list, and almost like a short list, which will help if you're at the stage where you want to invest and you want to engage more with your investments, but you find just the choice out there overwhelming. There's a thing called decision paralysis, where if you just have too much choice, then you end up not making a decision. So they can be really helpful. And the last thing I wanted to flag is using a financial advisor. So for lots of people, it might be that they don't have enough time at this stage in their life to do all of this work themselves. And there is 100% the option to outsource that to a financial advisor. You obviously pay a fee, but much like anything, there's people out there who don't want to file their tax returns, so they outsource it to an accountant. I think this is a perfectly valid and good route. You just need to be aware that for a lot of financial advisors, they'll have a minimum income, minimum asset level. So you need to have a decent amount that you want to invest for financial advisors to deal with you. But I think this is a really good way of outsourcing it if you don't feel like you have the capacity to do it at the moment. And then I just wanted to touch a bit on accounts and just run through a few of the account options. So the first one I wanted to flag that lots of people might be familiar with is a stocks and shares ISA. So you can open this once you're age 18. You can pay in up to £20,000 a year, each tax year. And crucially, it's tax-free. So what we would say is this is usually the first port of call for investors if they're starting to invest, because any gains that you make on your money will be tax-free, and any income that you generate from it will be tax-free. You can access it at any time. There are no restrictions on you taking your money out. There's also junior ISA available for children if you wanted to save for children. Another option would be a pension. So most people have a company pension or a workplace pension. You get tax relief from the government on it, and employers will often pay it into it. And you can pay in up to £60,000 a year. You get those same tax benefits that you get with an ISA. You can also, if you wanted to contribute more to your pension, you could set up a self-invested personal pension called a SIP, aside from your workplace scheme. There are rules, obviously restrictions on when you can access it, because it's a pension, the money is tied up for later in life. And then I also wanted to flag the lifetime ISA, which is quite often overlooked, but can be really good if you're saving for your first home. There's a number of restrictions on it. You can only pay in up to £4,000 a year. But the big bonus of it is that the government will give you up to £1,000 a year towards your savings. It also gets the tax-free benefits of an ISA. There are some restrictions, though, in terms of how you access it, either for your first property or at retirement, and you really need to look at the details of this to work out if it's right for you. But if at the moment your reason for saving and reason for investing is to save for a first property, then I would say definitely check this out and see if it works for you. And then the final account type is what's called a general investment account or a dealing account. Often we find some first-time investors can end up being in this account when actually they should be considering a stocks and shares ISA. This is kind of your broad open investment account. You can open it from the age of 18, pay in an unlimited amount, access it at any time, but you don't get the tax benefits of the ISA. So unless some people will use this if they've already maxed out their ISA, they've already paid in that £20,000 a year. But if that's not you and you've kind of defaulted into this account, then definitely check out the Stocks and Shares ISA. I'm conscious of time here, but I just wanted to run through very quickly 10 useful rules. So the first is to keep costs low. The more that you trade, often the more that will cost you. So really keep a check on how much you're buying and selling investments, and really keep a check on the costs that you're paying either to your platform or to the fund manager that you're buying from. Focus on risk, not just on rewards. So don't just be focused on, I want to make X returns in a year. Really weigh up how much risk you're taking for that. Be tax efficient, which I've covered in terms of using an ISA, and remember about inflation, which I covered with, cash and bonds and some of those other asset classes. Stick to what you know, I think, is a really key one. I think it's very easy to be kind of swayed into investing things because someone's recommended it or because you've heard people talking about it. If you can't explain the investment or why it should make you money or go up in value, then you really shouldn't be investing in it. So you either need to do more research or you need to invest in something that is a bit easier to understand. Think about why you're investing, because that helps you to set your goals and work out what your strategy is and where you should be investing. Be patient, do your own research as well, as mentioned before. Diversification, I think I've kind of hammered on about, and then get help if you need it. So whether that's from a financial advisor or other professionals. And then finally, I just wanted to give a plug to Money Matters. So this is our resource. We have a podcast, we have articles, we're on social media. You can go to the website, it's in the chat, but it's ajbellmoneymatters.co.uk, and you can find a whole load of resources in there about investing, but also just broader about finances as well. Thanks very much.
Great. Thanks for the presentation, Laura. Remember, everyone, if you've got questions for Laura, you can pop in your question in a Q&A box down below. We have a couple of questions here ready for you, Laura. I'm just going to run through them. So the first one that we have is from Carla. She's got a couple of questions. The first is a question regarding, I think, on your first slide, when you mentioned you've got up to 85K deposit protection by the FSCS. And Carla's question is whether is this per bank or in total per person. And the second question, just very quickly from her, is she's asking about your view on actively managed funds versus passive.
Okay, so I'll take the first question first. So it's £85,000 per individual per bank. So if you have more than £85,000 in cash, you can spread it across different financial institutions and you'll be covered. Also, if you have a joint account, then you get double that limit. Hopefully that answers that one. And then active versus passive. So I had a whole section in the presentation on this, and then I realized that I was really going to run over rather than slightly running over, which is what I did. I think it's something that you could talk about a lot. I think people tend to think that they need to be in the camp of one or the other. They're ardently behind active fund management, which is where just for those that aren't aware, where human fund managers run the funds, versus passives, which tend to be run by algorithms, or I like to think they're run by robots because that makes them sound more exciting. But I personally invest in both of these. So I don't think you need to be in one camp or the other. The benefits of passives is that they are cheaper and you can get broad access to markets for a very low cost, but you're obviously never going to outperform that market. Whereas active fund managers could be more useful in more niche markets. So for example, the data shows us that in the US market, there's little advantage in using an active fund manager. That very few of them outperform the market because there's so much availability of information out there that you can't really have that knowledge edge as a fund manager. But if we're talking about more under-researched and under-reported markets, more niche areas, whether that's going down into kind of a sector of the US or whether that's going into other geographies where they're kind of less researched and reported, then I think using an active manager can really help. But I don't think that you need to necessarily pick a side and stick with that. I think you can use them for different purposes.
Thanks, Laura. And it's great as well, because in one of your slides, you talk about the core satellite approach, in that some of you can go passive in your core and then in the satellite take on a more active approach. So it's not one or the other.
Yeah, exactly.
Great. And there is another question from Bailey. Her question is, What are your thoughts on investing in specific themes like AI, for example?
So I think this is a really good way of investing and how a lot of people invest. And I think actually, if you've got a particular knowledge area, you work in a sector and you might have a particular knowledge area, or for some people, it's that they've got a hobby in a certain area and they know lots about it, then I think that's can be a really interesting way to get excited about investing and get into investing. Or if maybe you're not involved in that sector, but you've spotted a theme that you think could be really good in future, then I think that's absolutely an acceptable way to invest. I think you just need to think about how much of your portfolio is that making up, and are you still getting a balanced portfolio? So in that core and satellite approach that we talked about earlier, for the example of AI, like Bailey mentioned, you could allocate that as one of your satellite bits on the side, and you could think, I think this is an industry that's really going to take off, and I'm going to invest in a fund that focuses on that. But you still know that you've got your core there. You're not betting everything on that trend. So I think that's something to be really conscious of. And I know that sometimes it's easy to get swept up in a particular trend or even a particular stock. So I think what we've seen, I mean, Tesla is probably the most recent example of this, of people getting very swept up in the share price growth of that. There is absolutely nothing wrong with that. And I'm not saying don't invest in Tesla, but I'm just saying you need to make sure that you've still got that core of your portfolio that's really diversified and spread around, rather than just betting everything on one trend or one stock.
Yeah, very good advice. The next question is probably more on budgeting. Basically, Jason is asking, what's your view on repaying student finance rather than investing? How do you think about that balance?
I think it's so tricky because the student loan system is so complicated now, and it's so hard to know whether you're going to fully pay it off. Now, I'm going to assume that Jason is in the most recent tranche of student loan, where you're obviously taking out much higher loan and the repayment period is much longer. So it's 30 years, or for those that started university this year, it's 40 years. And it's really hard basically to work out whether you're going to repay your loan during that time, because it depends on your earnings over that period. Now, you might be in a high earning career and you think you're going to pay it off over that time. But if you took career breaks, or if you took time out, or if you switch careers later in life, then that might mean that your repayments go down and you don't fully repay it off before that 30-year window ends. Which is not a very easy answer for you. I think if you're in the camp of you're in a very high earning career and you know that you're going to pay off that loan, then there's an argument that could be made that paying it off sooner will save you some of that interest cost. Conversely, once you've paid off that loan, you can't get that money back. And so actually, if your bigger priority in life is not paying off that loan, it's getting on the property ladder, and you've got money that you could invest to do that, then I think that you could invest that to do that. So I think it's partly down to your own kind of personal financial situation and how much you've got to invest and how much you're earning and whether you're likely to pay off that loan. And then I think it's partly down to preference as to whether mentally you would rather clear that debt and not have that hanging over you, or if you would rather save for something like getting on the property ladder or further training or whatever it may be, if that's more of a priority for you. So hopefully that helps a little bit.
Yeah. Sounds like there are a lot of considerations to take into account.
Yeah.
The next question is from Ellie. Ellie says, hey, Laura, I would love to know, firstly, how do you invest and what's your strategy? And also, what's one of the biggest lessons you've learned in your own personal finance journey?
So I invest in quite a light touch way. I mean, I'm not going to get it deep into my strategy, but I invest with a regular investment. Basically, my approach at the moment for the stage of life that I'm in is how can I make it as hands-off as possible? So I have a regular amount of money that goes into investments. It's set up automatically to do that, and I don't need to think about that each month. I would say a few of my golden rules are to make sure that you check in on your portfolio, but not too often. So every 6 months to a year, I will just check that everything in there is exactly how I want it. I will rebalance if I need to, but I'm not checking it every day and kind of obsessing about whether it's gone up or down. And I think that's a really key factor, is to make sure that you're not just reacting to what's happened recently. It's interesting. So I do the investing in our house and my husband doesn't. And quite often he'll come to me and say, oh, this thing in our account has gone down in value. And I think that's actually how a lot of investors feel. And I have this very pragmatic long-term view and have to kind of talk him down from selling things. But I think that kind of emotional reaction is very easy to have, and it's quite good to keep it in check, which is why I think if you have this strategy in place, that's much easier to keep in check. And one of the biggest lessons I've learned, I think, is to not just follow what other people are investing in. When I first started investing, I was working on the money desk of a national newspaper, and I just kind of, people were talking about, oh, I think this stock is going to go up. And so I just kind of invested without fully doing the research myself or knowing why it would go up in value. And it didn't go up in value. They were wrong. And so I think that gave me a really valuable lesson to be like, okay, don't just follow the herd, do your own research, invest in things that you're comfortable with and that you believe in and that you fully understand, rather than just following people that you think might be smarter than you or might be more in the know.
Yeah, exactly. I think investing for me seems like there's a lot more discipline involved than you think. Yeah.
Yes. Yeah. Trying to take out the emotion where possible.
Yeah. Thanks, Laura, for your time. And I'm afraid that's all the time we have with Laura for today. Thank you everyone for joining us today, Laura, and I hope this has been enlightening and informative for everyone here today. Thank you so much.